Okay, this is Professor Hazara, and this is the third video of the first initial five videos. I think they're pretty short on foreign currency transactions. These are the traditional accounting method for it. And let's just review what we just did in the transaction we just did. This was just your basic exposed net asset position. In the previous transaction, um, we had a company that sold 10,000 teapots to a British firm for 300,000 British pounds. At this date, each pound had a cost of $1.60. Then the date on December 31st, the end of this year, 2015, the U.S. firm closed its books, and the cost of each British pound had gone up. The value of each had gone up to $1.70, which means that you made 30 cents on, you made 10 cents on each British pound for a total of $30,000. So the first transaction was just debit account receivable credit sales for 480, which is the initial 300,000 British pounds times the initial value of $1.60 there. And then by the end of the year, you hadn't collected the pounds yet, but the value of each had gone up by 10 cents per pound. So from $1.60 to $1.70, which is right there, there's your $1.70. You'll be given the exchange rates. Okay, so um, this means that um, each pound is worth 10 cents more. So your total accounts receivable have gone up in value of 30,000 because they're going to give you 200,000 British pounds at the end of all this when the contract is settled. And as of the reporting date, those 300,000 British pounds are worth $1.70 versus the original $1.60. Okay, then we come to the final year here, or the final transaction when the transaction is settled, and they actually give you the British pounds. Now, when they give you the British pounds on February 20th, 2016, each one is worth $1.20. So this right here is the cash that you get on that date is worth 300,000 British pounds times $1.20. However, that's 50 cents less than the last adjusted value of $1.70. So you end up with a rather large loss there of 50 cents per pound. And then this is just a write-off of the receivable, it's the last balance, which is also equal to its 300,000 times $1.70. Take your choice on how to calculate that 510. Just add up the two adjustments, or take 300,000 times $1.70. Okay, now let's go to the hedge. Now we're going to use the same transaction, so there's some continuity here. And in this transaction, a U.S. company sells and delivers 10,000 teapots to a British firm for 300,000 British pounds at a cost of $1.60 each. So that's the same transaction. We're using the same transaction. But now the U.S. company decides to hedge this thing. And the way you hedge it is by entering into a separate transaction called a forward contract. And what the forward contract does, it's going to fix the exchange rate at what the market thinks the exchange rate will be at the time the contract is settled. So by doing that, maybe you'll lose a little bit, maybe you'll gain a little bit. But what happens is that you can sleep at night because the volatility won't be there. You know it won't go down to $1.15. You are fixing the exchange rate. And this is a type of financial derivative. If you study international finance, it's a type of financial derivative. Um, it's the easiest type of financial derivative. But let's go ahead and do the transactions. And what you're going to see is that I'm going to do the same transactions I did before for the exposed net asset position, this one here. But I'm going to add to that a couple more, well, basically two transactions to reflect the hedge. You're going to see that in accounting terms, the hedge is the mirror opposite of the account receivable transaction. So let's go ahead and start. Okay, so the first transaction is November 1, 2015. Okay, and I guess I'll leave that there. Okay, and the first transaction is the same we already had. We're going to sell. It's going to be valued at 300,000 British pounds. We're going to have British pounds, and we're going to each one's going to be worth $1.60. Change the formatting of this as I come along here. Let's make it. I don't know why they put that there. The date I guess I'll just put it in this format here. 11.5, keep it that far out there. 11.5.15. Okay, so 11.1.15. We're going to debit accounts receivable and put FC in parentheses there. That receivable is going to be worth 300,000 times $1.60, 1,000 pounds of $1.60, and we're going to record sales revenue for the same amount. I'm going to go ahead and once again format these because we have to. It's nice to know that we're dealing in two different currencies here. So we'll go down here and get the British pound symbol somewhere here, which is right there. And this will say this is dollars. Good. Okay. Okay, so here's the difference. So you enter into this contract. Now, if you didn't hedge this contract, that receivable would be exposed, the value of the receivable would be exposed to fluctuations in the foreign currency, as it was here. It went up by 10 cents, but then it took a big hit, went down by 50 cents. So, you're in the business of selling teapots here. You're not in the business of managing foreign currencies. So the way to handle this, if you want to eliminate or at least minimize the exchange rate risk, is to hedge it. And what companies do is they'll go, this is a separate transaction. They'll go in to what is called an exchange broker. It could be a bank, it could be any exchange broker on Wall Street. Broker means they buy and sell currencies. And they'll enter into a forward contract. And the forward contract fixes the rate. In this case, fixes the value of what what you'll get for those pounds when this contract is settled on February 28, 2016. So you can fix the exchange rate like this. Now you may ask yourself, why would you do this? Well, maybe, I mean, everybody's gambling here, except your gamble here will, on this contract, will be offset by the actual account receivable. So let's go ahead and see how this works out here. Okay, so I'm going to go ahead and I'm going to debit. Here's the nature of this contract. So this is, I'm going to put the descriptors here. So this is a initial sale. And this entry here will be to enter into forward contract with exchange So you're really dealing not just with your customer here, you're also dealing with the exchange broker. Okay, so I'm going to be, I'll say contract receivable. Which means I'm going to put, well, it's going to be in dollars, but I'm going to put contract receivable there. And what your contract receivable means that the exchange broker on February 28th is actually going to pay you some dollars because you're going to give them some pounds and they're going to pay you some dollars. Okay, and we're going to be dealing with 300,000 British pounds again. But, they're not going to give you any dollars unless you give them some pounds. So there's going to be contract payable. We'll summarize the nature of this contract in a second. There's going to be contract payable. I'm going to put foreign currency there because what you're going to do is you're going to take 300,000 British pounds when you receive them. You're going to give them to the exchange broker, and they're going to give you dollars in exchange. Okay, but I'm going to put FC because anytime I put FC beside something, it means the contract is settled in those 300,000 British pounds. It's like a hot potato. Where you have that FC, that means that the value can fluctuate with the change in exchange rate. And then here, I'm going to credit premium. Let's see if it's a premium or a discount. This is going to be a premium. On forward contract. And I'm going to say here, well, I'll put the amount and then tell you how you know that you can have premiums and discounts. And I'll tell you how you can have when you have premium or discount on a forward contract. Okay, so anyway, so contract receivable. We're going to be dealing in all cases here with 300,000 British pounds. Okay, so those are going to be the units of foreign currency. Contract receivable is going to be, this is the amount of cash that you're going to get when you take the British pounds that you've got from the receipt from your customer. You're going to take them to the exchange broker, and the exchange broker is going to give you some dollars in exchange. Now, the nice thing about this is you'll see here it says the forward rate is $1.65. So the exchange broker is going to give you $1.65 in exchange for each British pound. Okay, so the value of the forward contract, the value of the contract receivable is $1.65, is going to be $495,000. And I put here, this contract is fixed. The contract receivable, I'll say contract receivable is fixed. And what this means is that when you take the 300,000 British pounds to the exchange broker, when this contract is settled, that means you're not going to get any more than 165, you're going to get less than 165, but you're guaranteed to get 165, $1.65 for each unit of foreign currency. So that means that the you can rest at night. There's no risk in the contract, or at least the risk has been minimized. Okay. Now, the contract payable. The contract payable is the amount, the 300,000 British pounds that you're going to give to the exchange broker on February 28th when the contract is settled. So what's going to happen here 3 months from now, really, is you're going to get paid by the British firm. You're going to take the 300,000 British pounds, and as of today, those 300,000 British pounds are worth $1.60. So it's the same 480 you have here. And you're going to notice that the accounting impact of this hedge is that any changes in the account receivable can be offset by changes in the contract payable because they represent the same British pounds. Receivable is you get them from your customer, and the payable is you pay them to the exchange broker. Okay, that's the nature of this contract. Now, premium. You're going to have a premium. I'm going to say this is records premium on forward contract, and you have a premium when the forward rate is greater than the spot rate. I'm just going to put in here 1.65 is greater than $1.60. So we call it a premium. In this case, so we'll put $1.65 there, and then we'll put $1.60 there. Okay, so the premium is basically through the 300,000 pounds. So you've got a premium of 5 cents on each one. And what the premium is saying is basically it looks like you've kind of come out ahead here, at least, but it's only a temporary situation because the exchange rate on the contract payable can go up and down. What you're saying here is that you've kind of come out ahead because you're projected to get $1.65 for each one, and you will get $1.65 for each one. That's fixed on something that is worth today $1.60. So you got kind of coming out ahead. Notice it's credit, kind of like revenue. So it's kind of like credit, but in essence, usually you have discounts. Usually it goes the other way around, but it's a premium in this case. And so based on these circumstances, the exchange broker's kind of taking a gamble here that maybe they can win if they're predicting. In their own minds, they were predicting that the exchange rate would be below the $1.65 that you're going to get. So anyway, they're expecting a flip in the value. But anyway, so at least for the time being, your contract is fixed at $1.65, which you're going to get $495,000 on this contract. you will pay the exchange broker 300,000 units of foreign currency, and you really don't know how much these 300,000 units of foreign currency will be worth in 3 months. But you know they're worth $1.60 a day, so you're coming out theoretically ahead by 5 cents for each one. And you'll see that we're gonna actually amortize that premium here. Okay, so now we come to, and I'm gonna put a line here. Let's put sort of a line here, because now we come to the next important date here. Next important date is December 31, 2015. Of course, it didn't change. I'll just assume you know the date here. Okay, and there's going to be some adjustments here. Of course, no flow of cash takes place here. The only thing that happens here is that you're going to record changes in the value of the account receivable, because the exchange rate, I'm sure, changed. We'll take a look at that. And you're also going to record changes in the account receivable value, but also changes in the contract payable value. And this is really the entry where you're going to see the impact of the hedge, because this is an asset. It's going to be offset by changes in the value of the liability. Okay, so let's change the value of the account receivable first. So we're going to have account receivable. So we had the exchange gain here. Okay, and then we're going to have an exchange gain here. And these are the same numbers, same example as last time. Okay, so we're going to have the account receivable is going to be 300,000. Okay, the original exchange rate that we valued it at was $1.60. Now, just like in the last example, as of December 31st, the spot rate's gone up to 170. This is just the last example. We've just inserted a hedge here. Okay, so this is 1.70. It's the spot rate is now $1.70. And get this currency here. So we're going to have an exchange gain of 300,000 times $1.70 minus $1.60. We have an exchange gain, so we have an increase in the accounts receivable of 30, because our customer is going to give us 300,000 pounds, and like last time, they're now worth $30,000 more. So as of December 31st, anyway, we're going to get something worth $30,000 more. However, now we've hedged the transaction, which means we're going to receive something worth $30,000 more, but then we're going to take them to the exchange broker. We're going to give up something which is worth $30,000 more. So we get something that's gone up in value, that's a gain. When we give up something that's gone up in value, that's a loss. So what we've got to do is we've got to record an exchange loss, and we're going to increase the amount of our liability, and the reason for that is we're giving up something which is worth more. And it's just this entry is going to be the exact mirror image of the entry for accounts receivable. So the impact accounting-wise from the hedge is that you're protecting yourself. If the account receivable goes up, you're going to record a gain. However, your contract payable, because you're going to give up something of greater value, goes up, and you're going to record exchange loss. So all these gains and losses will be offset by those gains and losses there. Okay, so let's go ahead and get these numbers in. This is going to be equal to 300,000. It's just the mirror image times the $1.70 minus the $1.60, 30,000 and 30,000. So you have you lost out in a sense from this situation over here, in that you had a gain there, but now you had a loss. However, you could sleep at night because you can always have the value can always go down just like it did last time. And finally, the final thing we're going to do is we're going to amortize. So this records these two entries are to record exchange gain on account receivable. This one is to record exchange loss on contract payable, CBB contract payable. Okay, the final thing we're going to do here is we're going to amortize our premium. So remember, what the standards, the old standards said you're going to amortize that premium on a straight line basis, and so saying 3 months, really 4 months. So, but anyway, so a straight line is we're going from November, 2 months in 2015, 2 months in 2016. We're going to amortize half of that premium here. Okay, so we're going to debit the premium on forward contract, okay, and we're going to actually record amortize. We're going to call it exchange gain. You could call it other things, but it's going to be this premium times 0.5, half. Okay, so do that. And at the end, that premium will be written off. Okay, so let's go ahead, put a thick line underneath here, and finish this example up. Okay, and this is going to be, this one is 2. And in the new standards, you'll see that that's kind of what you do with premiums. You put them into the exchange gains or losses. Okay, now finally, February 28th comes around, and we're going to settle up. This is February 28th, 2016. And I'll just put this over here. It keeps changing the formatting. That's okay. Let's change the date. Hopefully okay, let's just put it like that. Okay, that's good enough. Okay, this is the date the contract is settled. So the first thing that happens is that you collect the British pounds from the British company. So that means that you're going to collect, I'm going to put an FC beside it because you're collecting British pounds. Okay, so you're going to collect the British pounds. You're going to write off the latest balance in your account receivable. So I'm going to go ahead and credit. And this is exactly like the last example. You're going to write off the latest balance in your account receivable. I'm not going to put up T accounts. You'll just have to calculate that. And let's see if you're going to have a gain or loss. Well, we know you're going to have loss because it goes down. The exchange rate's gone down to $1.20. Okay, so you're going to collect 300,000 units of foreign currency, and we're going to have a rather big exchange loss here. We already know it's $50,000 from the last example. Okay, so let's get these numbers in. This is going to be 300,000. The last recorded value on this contract was $1.70, so we'll get that in. This is going to be equal to 300,000 British pounds, and the current value of those is $1.20, and we'll format that. And then this is also going to be based on 300 British pounds. It's going to be based on $1.70, 1.70, and $1.20. Okay, so the value of the cash that we get today, by the way, is it's value, the last adjusted value. Oh no, what am I saying? The value of the cash that we get today is going to be based on $1.20 because we're going to receive directly from our British customer 300,000 British pounds, and those have gone down in value, like the last time of 360,000. This is the same journal entry as last time. The account receivable, actually, I should put here $1.70 because that was the last recorded value for this contract. So this is the contract last time we adjusted for it was worth $1.70. And the other way you could get this is to just add up this 480 on the account receivable plus that 30. That gives you that 510. I'm going to go ahead and multiply this out. And you're going to have this rather large exchange loss, which is equal to 300,000 British pounds times the difference between that $1.70 minus that $1.20. So you lost $150,000. So just like last time, you lost $150,000. However, whatever happens to this receivable, to the account receivable, the opposite, you're going to take the 300,000 British pounds, which were the receivable, which you settled now, you can take them over to the exchange broker and give the exchange broker. So you're going to have the mirror image effect on the contract payable. So we're going to debit contract payable foreign currency, which is the same exact, flow-wise, it's the exact same British pounds. Okay, we're going to have an exchange gain, and we're going to credit cash, which is the British pound. So what you're doing here is you're taking these 300,000 British pounds and taking them over to the exchange broker, which was your contract payable. Notice you had contract payable of 480 plus 30, which is 510 again, by the way. You're going to take them over to the exchange broker, and so you're going to record an exchange gain because you're going to record an exchange gain here, and then because you're settling a large liability for less than its value. If you settle a liability for less than your obligation, you have a gain, and then you're going to have your recorded exchange gain. So let's put these numbers in. You can see they're the exact opposite of these receivable transactions here. Okay, so this doesn't matter. Okay, the cash that you give up is worth $1.20. Your exchange gain is going to be equal to the 50-cent difference on each pound, and the this is going to be $1.70 because your contract payable, we'll get in a second. Your contract payable, and this will be $1.20. Exact mirror image. Okay, let's deal with the contract payable first. Contract payable is going to be 300,000 times $1.70. Now keep in mind that's denominated in foreign currency. So you can take the latest. What we're saying here is that that you're going to take these 300,000 pounds that you got, and you're going to take those physically over to the exchange broker, let's say, and give them to the exchange broker. And each one now has a value of $1.70. So you're giving up something that was last valued at 510. And the easiest way to get that is just take it times 300,000 times $1.70. Or you can also add up this contract payable 480 plus that 30. That's also going to give you that 510 right there. That's another way to do it. Okay, now you can have an exchange gain, and it's going to be calculated the same as last time. It's going to be 300,000 times the difference between $1.70 minus $1.20, 150,000, and then your cash that is worth 300,000 times $1.20 gives you 360,000. Now notice that 150, all the gains or losses on the account receivable are offset by gains or losses on the contract payable, because it's the exact same pounds. You get the pounds from your customer, you take them over to the exchange broker. One's on receivable and one's on payable. Okay, so notice that gain was offset by that loss, and that loss was offset by that gain. The only thing that has impacted any of this is, and you ended up winning big time here on the premium. You originally got into a contract which was predicting you'd have a gain, so you had a little bit of a premium there. Okay, so we'll go ahead and we've got to amortize that that premium, and then we'll actually settle the final contract. Okay. And so we'll get this out of the way here, and we'll settle up with the more important thing. I'm leaving it till last. So we amortize that, and you'll notice that the premium on started with a premium of 15,000, and now you wrote it down twice, so now it's 0, and you split the amortization up, recorded sort of $15,000 predicted exchange rate. You split it over price now. Now the final thing is there's one final transaction. I'm leaving it to last to emphasize because people always forget this. You've collected the cash from the British customer. It was worth 360, which means a big loss. However, you took that cash, took it over to the exchange broker. So this is the exact same cash, and you gave up something worth more, or you settled its payable for a lot less than its obligation, your last quarter obligation. So you had an exchange gain which offset that loss. So you have a mirror image. So you've gotten the cash, gotten the 300,000 British pounds. You took it to the exchange broker, and notice you've got 360 in cash, foreign currency, and you give it to the exchange broker. The one last thing you got to do, and everybody always forgets this, but I always leave this to last to emphasize, one thing you haven't done is collected the contract receivable from the exchange broker. We're all the way up here. We had this contract receivable, which was, as I said up here, it's fixed. So you better not forget that. We're going to do this since it's a summer. We'll do it by Brightspace. Never forget to collect your cash. It's you collect the 300,000 from the pounds, take them to the exchange broker. So you've collected 300,000 pounds, give them to the exchange broker. The exchange broker now owes you 495,000. So we're going to debit cash. And by the way, this cash is dollars. So this cash is not the foreign currency anymore. You contracted to get to the exchange broker. This is fixed, by the way. And we're going to credit contract receivable, and the contract receivable, this was fixed. This was fixed at 495. So you really made out like a bandit on this hedge, 495. So you ended up freezing. What happens is did two things. You end up freezing the amount that you get on those 300,000 pounds at $1.65. Because the exchange broker mispredicted, you end up making this additional 15,000, which was recognized over the 2 years. But that $1.65 there is, I just want to emphasize this. This amount was fixed up here. The exchange broker got into a bad transaction, you won. But the major effect here is that was that you were able to sleep at night, because unlike in the last example, you had a gain here, which was offset by that loss. You say, well, we had a loss. We made 0 on that, which is true. However, you were also able to offset that rather large $150,000 loss with that gain. So on the whole, all losses and gains were offset with each other except the premium on the forward contract, which you recognized $7,500 here, $7,500 there. So you ended up not only being able to hedge your transaction, which means that the exchange gains and losses offset each other, so they ended up at 0, but you made a gain of 5 cents because the exchange broker was not very bright. But the main purpose of this is to have any gains hedged on the receivable hedged by losses in the forward contract, and vice versa. The purpose is not to make money or lose money. The purpose is to hedge a transaction and eliminate the exchange rate risk, so that you can guard the value of what you're in business doing, which in this case is selling teapots. Okay, I'll put this video up, and now we'll go on to exposed net liability positions. Okay, so that was 34 minutes.